When should I adjust my investment risk in my retirement planning timeline? Are you wondering when to change your investment strategy as you approach retirement? This is a common question, and understanding the right timing can make a big difference in your financial future. The key time to adjust your investment risk is during the retirement risk zone. This period typically spans about 10 years before retirement and about 10 years after. During this time, your investment strategy should shift from focusing on growth to being more conservative and income-focused. Let's break it down into clear phases. First, in the early accumulation phase, which is many years before retirement, you have a longer timeline. This means you can handle higher investment risks. You can invest more in growth-oriented assets like stocks. The goal here is to maximize your growth over time. Next, about 10 years before retirement, you enter the retirement risk zone. This is when you should start gradually reducing your risk. Shift your portfolio toward more stable investments, such as bonds or cash equivalents. This helps protect your savings from large losses as you get closer to needing to withdraw funds. Your focus should now be on preserving your capital while still allowing for some growth. Once you retire, especially during the first 10 years, your investment strategy needs to be even more conservative. This is the most sensitive period because you are making withdrawals while your portfolio still needs to generate income and growth. The risk of market downturns is highest here. If the market drops early in retirement, it can significantly impact how long your money lasts. To manage this risk, your portfolio should focus on income-generating and lower-risk investments. As you move further into retirement, your risk tolerance may continue to decrease. However, some retirees may choose to include moderate growth investments based on their needs and life expectancy. It is important to regularly review your portfolio to ensure it aligns with your evolving risk tolerance and financial goals. There are additional practical steps you can take. Regularly review and rebalance your portfolio. Market changes and life events can affect your risk tolerance and timeline. Adjust your asset allocation to maintain the right balance between growth and safety. Consider flexible withdrawal strategies. During market downturns, you might want to withdraw less to preserve your portfolio's value. This can help sustain your retirement funds longer. If markets are volatile or your savings are lower than expected, delaying retirement by a few years can give you more time for recovery and growth. Also, think about alternative income sources. Supplementing your portfolio income with Social Security, pensions, rental income, or part-time work can reduce pressure on your investments. This allows for a more conservative portfolio. In summary, start adjusting your investment risk about 10 years before retirement. Gradually shift to more conservative investments and maintain this defensive strategy during the first decade of retirement. Regularly review and adjust your portfolio to reflect your changing risk tolerance and financial needs. This approach helps balance growth and preservation, aiming to sustain your retirement savings over the long term.